Hello, everyone, and welcome to our webinar co-hosted by Armanino and LoseList. Today, we will be talking all about PPP 2.0 and the Employee Retention Credit. We have a lot of great content to cover. My name is Sarah Chida, and I'm part of Armanino's marketing team. But before we get into the content, I have a couple of housekeeping items that I just want to let the audience know. We will be having a Q&A session at the end of each section of the presentation. We have two sections today, one on PPP 2.0 and the other on the ERC. So please use the Q&A box on your webinar panel to submit your questions to our experts. We will answer those questions as time allows. Also, we are recording today, and so we'll be sharing a link to the webinar recording as well as the slide deck 24 to 48 hours after the webinar. So keep a lookout for an email from us. Sometimes these emails get stuck in spam folders, so please make sure to check that if you don't receive an email. Let's introduce our speakers for today. We have Lou Fisher, as many of you already know. He's the founder and president of LoseList. We have Jen McCabe, who's a partner of our consulting group, and she leads our business outsourcing services practice. And with that, I'm going to hand it over to Lou. Lou, you there?
Yep, thanks, Sarah. Sorry about that. Welcome everybody. Glad you could join us this afternoon. I appreciate all of you jumping online here at the end of your day and tuning into this kind of riveting topic. I hope, and I think you'll find that Jen's really an expert in this thing, and so if you have issues that you saw, that something jogged your memory in the stuff we sent out as it relates to PPP 2.0 or the ERC, that we hope to try to answer some questions or at least jog some issues for you so that you can help get them resolved. As many of you likely know, a group of us rallied a team of advisors through LoseList to kind of help out a lot of folks with the early PPP loans through a group called the FAN, the Finance Assistance Network. And we did not rally a group for the second go around. We just didn't see the need from that perspective. But in the first round, Armanino was one of our kind of outside professional advisors that helped a lot of our team help these folks get through the first round. And so and Jen was very instrumental in that, as well as some of her other partners and so forth. So before I introduce Jen, who is the resident expert here on both these topics, and you'll see that very quickly, I just wanted to echo that we are doing a recording. There are a bunch of frequently asked questions stuff that there's going to be links to that you guys can see to try to get answers. I know it's really hard on these webinars. You might be sitting back with your particular question, and we'll try to get to some of those. And I think they said you can enter questions in there, and I'll try to cherry pick some of those if we can. We obviously will not get to all of them. There's going to be some session in the middle here where we'll do that. But we're going to go through these slides and data relatively quickly. And as Jen says, we're going to kind of touch the top of some of this stuff. So with that, Jen is a partner. Jen McCabe is a partner with Armanino. She's been there since 2017, where I think she merged her firm. She had a team. She founded and led a Team Gen Corp, a firm that was dedicated to strategic financial management of startups and small businesses, and had kind of a comprehensive back office solution with accounting, finance, and HR. And then she also had previous roles prior to that at like an advertising giant called Ogilvy and Mather, and then in cash management industry. So she's very, very well versed in this stuff. She's got 25 years of experience. And so with that, I'm going to turn this over to Jen, and she'll start the slides. So again, thanks for attending.
Thanks, Lou. All right, I will try to make this not too boring. This is tough stuff, and I'm going to hit on things that I run into every day and try to stay away from the obscure things. So Sarah, let's hit first this slide. Just it's obligatory forgive me. I do want to say that Armanino, as a firm, is in the top 25 in the country now. So we sound big on paper. You can see that we have a lot of awards for client service. I think the thing that's most important is our purpose. We're known for being innovative, meaning we're really into technology, and it's very important for us to be positive. We actually fire people who are negative Nancy's. So our culture is really cool. Matt Armanino is the managing partner of our firm, and his father founded the firm. So it's this funny combination of a family vibe with a mid-sized to big firm vibe. I am very happy there. I fit there because I don't think I'd fit at a big four firm, but it allows me a lot of latitude. All right, let's move forward. We're going to hit the PPP. And so we'll start with what we need to know that we learned so we don't make those missteps. I'm sure y'all remember the panic of the first go round. Then we'll talk about the second draw and what's different and what's the same and try to make it really clear. And then I'm going to hit on the employee retention credit. It used to be a separate topic because before December 27th, you could not get the retention credit if you had a PPP. And that all changed on December 27th. So it's been absolute madness because the retention credit is a very powerful credit for a lot of small businesses. We've been working on this since last April. Suddenly, people are aware of it now. So I want to make sure I teach you guys enough to know whether you can use it. All right, let's dive in. All right, PPP 1, we certainly did learn some lessons. First and foremost, we learned about banks. I have the unfortunate luck of seeing under these banks' kimonos on a regular basis. My partner, John, has actually put us in a situation where we are working for banks and we are helping them advise their clients, or we are helping the banks develop their processes around the PPP. And so we get to peek at things that the SBA sends to banks. And we get to see which banks have portals that are open, which ones don't, which ones are kicking back applications for no good reason. And suffice it to say that choosing a lender is important. I will go so far, I hope I don't hurt anybody's feelings, as to say that the biggest banks are the ones with the oldest technology. They are lumbering and having a hard time. I am more impressed every day by the nimble, smaller banks. And the community banks are really diving in this second time around. I get asked every day, should I switch banks? My answer is yes. If you had a yucky experience, you didn't have good client service, the community lenders have been better. They're not perfect either, but at least you'll have a person who you can go beat on around the corner. And on the SBA website, it's very easy to Google local community banks that are doing PPP lending in my neighborhood. And so I recommend that. I have been unimpressed with the biggest of the big guys. They have been doing the absolute slowest, worst jobs. And they also don't notify their clients when their clients are having trouble with their applications. The first time around, a lot of people had applied with those big banks and they didn't know that the portal had been shut off and that they were not going to get funded at all. So be careful out there, folks. Let's go to the next slide, Sarah. All right, this is the other one. I don't know if this applies to a lot of people, but remember there was a big panic over if you borrowed money and you might not really need it. When you sign the application for the PPP, we are learning, because audits are starting to happen now, even for loans that are less than $2 million. The thing they're very interested in is this attestation to uncertainty and actually needing the money. And this makes sense because in the PPP2, you can see them really closing the window and trying to make sure people who have other access to funding can't finagle their way in. If you have more than $2 million, I don't want you to submit your forgiveness application until you have the 3509 prepared. So the 3509 is a form that is literally a document verifying eligibility for these PPP loans. It's horribly unfair because it says to you what's going on in your business. And you didn't know how your business was going to do. And a lot of people, thankfully, have done better than they feared. So the 3509 is a form that the bank will come back to you and ask for and say, hey, where's this? And you've just submitted your forgiveness. And then they also say, you only have 10 days to do it. So if you are listening to me and you have more than $2 million in a PPP loan, do the 3509 first. When you do the 3509, there are boxes that you can check next to every answer that say, I want this to be confidential. Check that box every single time, because remember, the PPP is public, but if you check those boxes, your detailed answers do not have to be public. I also have found that submitting the 3509 is a recipe for disaster unless you have it supported with a narrative. So what we advise people to do is submit a narrative that says, here's what my business is and does. And then the second part of the narrative addresses liquidity matters. And the 3509 form, you just refer to your memo a lot, and therefore you're forcing an auditor to read your answers. If you submit the 3509, it's like sending in your 1040 to the government and having some really auditable line that sticks out like a sore thumb, and then they come back to you and ask you for your receipts and you don't have them. That's the best I can put it to you. All right. So we have a narrative that supports the 3509, and we also help our clients construct exhibits to support their state of mind back last April. So everybody who got a PPP last year was freaked out. You need to document how you felt when you applied for the loan, not what they're asking you on the 3509. It's not a fair question. And I'm telling you, they're starting to ask questions of people who have less than $2 million if they suspect you are affiliated with another company that might have money. So be ready for these eligibility questions. They might not be fair, but they're coming. All right, let's go to the next. I'm not going to stay on this slide. I will show you, you'll get these slides, remember, at the end, but this link in the middle of the page that says articles, federal state tax implications, that's where I go almost daily, because the list of states has changed every time I've done this slide in a presentation. The states are changing all the time. It's really irritating. And the bottom line here is the feds, remember, said this isn't taxable, or actually the Congress said that. Then the IRS said, no, wait a minute, forgiven debt is taxable. And Congress said, well, that's not cool. And so then the IRS came back and said, okay, we will let the income be not taxable, but you can't deduct the expenses, which is the same difference. It's crazy. But the feds have now said, for real, it's not taxable. The states, though, are broke. They've been paying tons of unemployment. They need the revenue, and they are reluctant to make it tax-free at the state level. So you need to make a plan about it. This slide could very well be wrong by today. Don't hold me to it. Go to that link instead. All right, let's go to the next slide. All right, so we have this new Economic Aid Act, and here we go. Here we go again. But don't panic. It seems to be much less crazy out there. People are not rushing to the trough to get their second PPP. If you are applying for the first time, the rules are the same for you as they were last year. If it's your second draw, there are new rules. It's nice that they're now releasing a form for people who have less than $150,000. Don't be fooled. It doesn't mean you don't have to have all the backup and documentation in case they come and ask you for it, though. So it's nice that it's a simple form. What that does is it speeds your forgiveness through and it gets it off your plate. It doesn't mean you don't have to do all the math. You still have to do all the schedules, okay? There are more expense categories, which is nice. They're less narrow. It still has to be, important. You can't go buy a Ferrari. It still has to be real. And this is important. You can choose any period between 8 and 24 weeks. It used to be 8 or 24. And because we're going to talk about the employer retention credit, I think that's important. If you can shorten up your covered period to say 16 weeks, it leaves a lot more room for you to go after that employee retention credit. Okay, let's hit The next one, I think we're going to get into some wordiness, and I'm not going to read this to you. I've highlighted in red the things that are more applicable. So we have the simple certification I talked about. We have the defined covered period that you get to pick. You don't have to have 24 or 8, which can be very strategic for you. New expense categories. I love that they expanded payroll costs because there's so much confusion about what you can include. They are now including disability if the company pays it and group life if the company pays it. So that's nice. Let's go to the next one. Remember, you get these slides at the end. This is important. The loan application forms have changed. All of them have changed. Some banks are requiring borrowers to fill out a new loan application form to conform to the new forms because they've changed all their technology at the bank. So your form might not work. So beware. You can easily Google it and compare them, but they are different. The uses expanded to include supplier costs. If you haven't submitted last year's application for forgiveness, you can do these rules now. So it might make sense for you to include other operations costs, critical key supplier costs, if you had to buy a bunch of PPE, if you had to put up plywood to protect your shop during riots, you're allowed to include that now. I think those things are helping the smallest businesses, the Main Street businesses. And then there's this thing, I had 3 new certifications here. I have no SVG here. What that is a shuttered venue grant, which is an amazing program. And because the shuttered venue grant is so amazing, you can't also get the PPP. That grant is for you if you have a venue with fixed seating, you're a theater per se. It's to save our stages is the way that a lot of us talk about it. So if you're doing that, don't do the PPP, and it's okay because the SVG is fantastic. They finally just flat out said if you're publicly traded, you can't do this. Remember last time you kind of could. And they've excluded a federal executive and their families from getting a PPP. That's interesting. It makes me wonder what happened the first time around there because I didn't run into that, but it's a fun little ad. Okay, let's go to the next slide. All right, so let's talk about the second loans. This is what people ask me about all day long. This is what really matters. You have to have more than 25% drop in gross receipts in any quarter of 2020 versus 2019. So a lot of companies that I work with have suffered that drop in the second or third quarter, but they bounce back up in the fourth quarter. They may not have an annual drop at all, but they can still get a PPP2, a draw 2. If you're a dinky business and you only do your books once a year and you only do them cash basis, they will take that too. So they will take year on year, but they want you to have done a pro forma tax return if you go that route. They will accept bank statements as your backup if you always just do cash accounting, you don't really have books. So this is meant to help the tiniest businesses. They reduced the head count to 300 or fewer this time. And I've got an exclamation point here. People get confused on the head count. When you apply, it's head count, it's noses, full-time, part-time, and worldwide. So if you are affiliated with some company in the UK that has 301 people and you have 10 people, you do not qualify for a PPP. They are definitely on the affiliation thing now. So you got to count noses, part-time and full-time. However, they use full-time equivalents when you're deciding what you're forgiven for. It's a confusing problem for a lot of people. And if you are going to get a second draw, you must have spent the first draw. They don't want to just throw money at people who are still, piddling around and haven't managed to spend the first draw. This is a little bit punitive for bars, nail salons and things. If you're listening, I have a couple ideas about that. You don't have to have filed your forgiveness though. It's okay. The biggest problem that we've run across is that many people do not know their SBA loan number. They have their bank loan number, but they don't have the SBA loan number because their bank, usually a big bank, by the way, has failed to put the SBA loan number on any documents. and they cannot reach the big bank to get the SBA loan number. This is the largest problem that I'm having on a day-to-day basis. So far, safe harbors are the same, which is a little bit weird, but it's good. It's less brain power. All right, let's move along here. I'm going to skip this also because I want you guys to just have this slide so that you can see the comparisons if you need to. Let's go to the next slide, Sarah. All right, now let me hit on some constant questions so that I'm hitting the most often asked questions. Let's move on. Let's see. Okay. Covered supplier costs. The best way for me to explain it is that it needs to be necessary to your business. It needs to be a necessary and usual expense. So if it's something that keeps the doors open, you can argue that it should be included. I've run into some kooky questions, but if you can show that in February of 20 and before February of 20, it was a normal, usual expense and that you paid it regularly every single month, it's fine, okay? It's supposed to be a lot about data. You know, people were saying, wait a minute, I want to make sure my connectivity and all my utilities are covered. My waste, my trash expense is critical to me, things like that. Okay, let's go to the next one. Gross receipts. So this is your top line, of course, on your P&L, unless you are an agent of some sort, real estate, advertising, and you're defined in your contracts as an agent. Everyone else is that top line, but you also need to add in interest, dividends, pretty much everything but cap gains. So if you sublease your rent space and you have rental income down below the line, you need to include it. It's all the money coming in, okay? And you will have to show your financials and attach them to your application. So you'll have to show this year, last year on your application and make sure that you're doing it right, okay? Read the instructions. And the next one is, what will they ask you for? So as I've said, maybe bank statements, maybe this year, last year tax returns. Most of you will be able to just attach your internal prepared financial statements this quarter versus last year, same quarter. And you don't have to convert to accrual if you always do it cash. If you always do your books on an accrual basis or even a modified accrual basis, they are saying you should do it in the way that you usually do your accounting. So if you're using 1 quarter of the year, you shouldn't screw around and try to do cash basis and accrual basis. You need to stick with what you always do because you'd have to go back to all of last year, restate everything to a new method. That's, if you really are doing those backflips, just don't, because it's not worth it, especially if you get in trouble later and they don't forgive you for it, right? If you do accrual basis accounting during the year and you convert on one day to cash basis for tax purposes, I still am reading it a little bit literally, which is quarterly, do it the way you always do your books. If you want to argue cash basis, I think you're going to need to do it annually and show an annual drop of 25% or more, okay? The lesson here is don't get too tricky because I think that that's a recipe for disaster. All right, and what's the next one? All right, on that whole $2 million thing, I get this a lot and it makes me nervous. If you get a $1 million loan and another $1 million loan, are they gonna bug you about whether you're eligible and argue with you that you didn't need the money? Probably not. I'm nervous about it, but my partner, John, who does a lot of these with me, is not very worried about it because the whole application, you have to prove that you're a small employer, number one. And you also have to say you had this drop in receipts. So it sort of proves that you need the money. He's not as worried about it, okay? All right, let's move now to the, yeah?
So Jen, we have one question in our Q&A panel. They were asking, do you have to use the same bank as you did with the first PPP?
No, the answer is absolutely you do not have to use the same bank. And if you had a bad experience, don't. Move to a community bank if possible, one that's around the corner that has a human being that you can talk to and that is excited about these loans. The small banks are more excited about it than the big banks. They can service the loans better. I would absolutely switch if you had a bad experience. By the way, the reason to stay with the first bank if you had a good experience is that you can kind of just put your application on repeat. You just submit the same documentation. So that's one advantage. All right, so if you're listening and you like to do this yourself, we have written over 600 FAQ answers after having done about 50 webinars in the last year. We have answered 600 of these suckers. So you can go to this link and it's searchable. You don't have to scan through 600. You can say what your topic is and it will bring up all the times you've been asked that question in a variety of ways so that you can do it yourself. All right. If you need help, you are more than welcome to call us. We've set up a bit of a conveyor belt. There's a lot of people who are financial analysts, and we've got a modeling process where we just gather everything and we have a kickoff meeting with you. There's someone like me on the team and 2 analysts, and we prepare all the forgiveness. We go to the bank portal with you. We submit it with you. We screen share with you if that's what it takes. We do whatever it takes, and we figure out the forgiveness to get you the most possible. Okay, there you go. You have options. You are free to do it yourself or with us. And now are we going to the ERC? I think that's what my next thing is, Sarah. All right, let's dive in.
One more question, Jen. Someone saying, like, since the money is fungible, how do you determine that you quote unquote spent all of the first PPP funds?
Well, this is where you do need to do your work papers. You need to, in your covered period, which begins the day that you got your money, always, it's the day that money hit your account. You need to look at the amount of money that you were given and see if in at least 24, say in 24 weeks, you've spent it all on payroll. That would be your answer. If you spent, remember the rules are you have to spend at least 60% of the money they give you on payroll. So you'll have to look at that. I think it's very important in your accounting systems that you are tagging the use of funds. And even in QuickBooks, there's a way to use a job code or a class code to tag things, and you can run a report on how much you've put to that account. We had advised people last year to put the money in a separate bank account if there was any doubt that they were going to be able to track it. But if you're asking me that question, you need to do the work papers. You need to start filling them out so that you know that you've spent it all the right way, okay, on approved uses. All right. Now, this is really important. I want to make sure that we shift gears. So the ERC is the Employee Retention Credit. This is for people who pay employees, like the PPP, and specifically continue to pay people even though their business is really having a rough time. So if this is you and you kept paying people, that's why you need to listen. It's a very interesting thing that a lot of people are taking advantage of for the period last year in March in particular, before we knew what was going to happen. In 2020, the credit is up to $5,000 a person. In 2021, they just recently changed it. It's up to $7,000 a person per quarter. So if you do the math and you're just a tiny business, you know, say that you're a business with 20 people and you get $7,000 a quarter, that's $140,000 credit. And I'll explain how it works. And if you're perplexed, I want you to know that it is refundable, which means that if the credit that you get is beyond your payroll taxes, they actually send you a check. And if you qualify for it, and for example, first quarter, if you're listening and you go, wait, I can qualify for that, there's a way for you to get the credit in advance. So it's meant to be instant cash in businesses' pockets when they really need it. So this is a powerful program that a lot of people don't really understand. And it's a little complex, but I'm going to try to take you through it. Okay, let's talk about 2020. All right, cast your mind back to 2020 first. Ignore today. Last year, did you have your gross receipts, your gross revenues? And we'll worry about the definition of revenues. Just think about your business. Did it drop more than 50% last year? Or did you have disruptive government orders? Almost everybody had disruptive government orders unless they were an essential business. So this doesn't apply to like telecommunications giant who obviously was hosting Zooms constantly, although I'll give you an example where it would. So it's an or question, not both. If you say, well, Jen, my receipts didn't go down 50%, my next question to you is, so what happened when your locals shut you down, sent everybody home? Were you groovy? Did you not miss a step, or was it a pain in the butt? If it's a pain in the butt, you might qualify for this credit. All right, so either one of those answers, you may qualify for the credit. Now here's another really important question. The amount of your credit is based on the number of employees that you can get that $5,000 per head. It is hinging on whether you had 100 or less employees, and in 2019 before the pandemic. So when I say 100 or less FTE, the first question I ask everybody on ERC is, how many FTEs did you have in 2019? And an FTE is someone who worked 30 hours or more. So you have to add up your part-timers and clump them all together in chunks of 30-hour weeks, okay? But if you had 100 or less FTE staff, the credit applies to everyone that you paid during a period in which you were disrupted. So let me say that again. If you experienced a disruptive government order and it screwed you up, and you can show it, and you can say, look, I had issues, I had to adapt, I had to pivot, and you had less than 100 people, you can get up to 5 per person in this credit. There's some work to do. There's ability documentation, but it's well worth it. If you had more than 100 staff, you're still eligible. You can still get it, but you only get it for the people that you paid who were unproductive. So for example, say that your salespeople suddenly couldn't travel. You would apply it to your salespeople if you have more than 100 folks. If you stopped hiring, your recruiters would have been paid but not productive. If you laid them off and you only paid their health insurance, you can get the credit for the amount you paid for their health insurance. So this is to reward you if you paid people who really were kind of at home watching Netflix and you kept paying them because you didn't know what to do, or you were waiting for your PPP to fund and you didn't want to fire them because you had heard that the PPP was going to require you to keep them on staff. Okay? This is very applicable to most people. All right, let's go to 2021 because now it gets to be a real boondoggle. In 2021, you only have to have a 20% drop in revenues comparing 2021 Q1 or Q2 to 2019. Again, the base year is 2019, pre-pandemic. Now, I have this thing here. It says, or when comparing Q4 2020 to 2019. It is my Jen McCabe assumption, so don't, hold the treasury to it, that they will allow us to be eligible for the Q1 credit of 2021 if in Q4 of last year, your receipts only dropped 20% or more. And that's a technicality that I believe the Treasury is going to confirm. Again, it's the 20% drop in revenues or a disruptive government order. A lot of people were still subject to disruptive orders in the first 3 weeks of January. Bars, restaurants, hotels, even car washes, nail salons. So you could qualify for this credit if you answered yes to either one of those questions. All right, it's much easier to qualify at a 20% drop in revenues. If you know for sure right now that your Q1 revenues are going to be more than 20% down, you can get an advance on this credit right now. There is a form that you can file, okay? Now, here's the other crazy thing. It's 500 or less FTE. So if you have 200 people on your team in January and you were disrupted by a government order, the credit you're eligible for is up to $7,000 a person for your 200 people. And that is a whole lot of money, a whole lot of money. If you have more than 500 staff, we can only get the credit for people that were paid but not productive. So say that you had more than 500 staff. Again, it's worldwide staff. Let me just say that. So say you had 200 in Denver and you had 600 in New York. We would have to apply this 500 rule. And say you had buildings and you had maintenance crews and security guards and people like that who you continued to pay, but who are working 1 out of 5 days instead of all 5 days. These people can be identified and they need to be written up. It's a bit of an HR exercise sometimes. The way that we approach this is we use our HR team working with the clients to define people's job roles. And then we, of course, have our payroll certified specialist building intricate worksheets because you can't overlap the ERC with the PPP. All right, so we're going to talk about the work papers to make sure that doesn't happen. I hope that I have pounded it into your skulls that this is a lot of money. I've told you how to be eligible as an employer. It's a shutdown or a reduction in gross receipts. The business must not be deemed essential because we're going to have to look at those shutdown orders and see if they apply to your business. And if your business is named as one of the ones that's supposed to stay open, like a grocery store, it's not going to work unless we can identify a population in the grocery store that was sent home and continued to be paid, for example. Eligible wages, the cutoff is 100 people in 2020, 500 people in 2021. And the staff count is the tricky one sometimes. If you're close to 100 and close to 500, we actually need to prepare a work paper to do the math on FTEs. It's not like the PPP, which was a 40-hour week. It's a 30-hour week. All right. That's the summary. Let's keep going here. The work papers are required because you can't have overlap. If you have done your PPP forgiveness, you know that you have to do it by person, by day, by pay period. Therefore, best practice is the ERC is also by person, by day. So if you have eligibility for this credit in March, say beginning March 13th, and you got your PPP on April 13th, the period up to the PPP funding date is where you would apply the ERC and you would prepare good work papers. You also need to back out Family First, paid leaves, and R&D credits, okay? So work papers are critical. You gotta be smart about it. All right, let's go to the next thing. All right, let's hit them. All right, base head count. This is global head count. The determination is based on control group. So even though you may not own majority in a couple companies, it's not just equity. If you're the boss of a couple companies or you're the president and not even the owner, you're still in the same control group. So this is the sticky point. You got to make sure that this employee count is correct. All right, let's go to the next one. A government shutdown order is interesting. This is a federal law, but most people use state shutdowns to document the fact that they were sent home or that they were told they could only have one table out of 4 filled with people. So we'll use just about anything, providing we can tie it back to the business and have a discussion in a documented memo. We write a technical memo for the clients that we do this work for. And in the technical memo, we talk about how the business was impacted and we refer to the order that substantiates our case. Okay, let's go. Gross receipts, again, is not just your gross revenue. It's going to include dividends, rental income, interest, non-earned income. So it's everything. And if you are affiliated with another company, another common brother, sister entity, a parent entity, it's the whole kit and caboodle. It's not just one little company in a controlled group. It's the whole controlled group. Okay. I think I have one more. Oh yeah. Don't just have your payroll company do this, please, I beg you. So the payroll companies are saying, just give me a number, or go into the system and tag a few hours for Jen McCabe as ERC eligible. That's a real problem for me because people are coming back and saying, I'm not really sure I did that right. Well, it's too late. You got the money from the government, so now you've accidentally perpetrated tax fraud. So do the work papers very specifically. Document why you're eligible first. Calculate the number. Then give it to your payroll technology and have them process this for you. Sometimes they need to be bullied. A lot of them don't understand it very well. So we sometimes have to talk to them and talk them through it. But for sure, make sure you have documented the calculations and your eligibility on your own. When I say this, I hope you guys remember I said this, your payroll company, ADP, Paychecks, whoever they are a technology. They are not an advisory. So in this case, it's really clear. That's always the case, right? But when it comes to the ERC, it's absolutely technology to help it, but they will not be the advisory that you need. All right.
So Jen,
And
we have a couple questions actually before we go into the case studies. A couple related to PPP and then a couple related to ERC. So first one is, how do private education institutions like grades 6 to 12 qualify for a PPP loan?
well, if there's nothing excluding you, as long as you satisfy the regular headcount criteria. We have some religious organizations that qualify, because remember, there's an exemption for religious organizations and hotels that says it's less than 500 people or less than 300 now per location. But providing you can satisfy the normal PPP requirements, there's nothing stopping you from applying.
All right, so a hybrid question related ERC and PPP is that if you receive a PPP loan, say in mid-April 2020, but were closed from March 13 to March 13, 2020, would you qualify to get the ERC for the month before PPP?
Yes, absolutely. You just have to make sure that you don't have overlap in there, because a lot of times the complication is the PPP funds on, say, April 14th, and you pay payroll on April 15th. That April 15th payroll is inside the covered period and it covers back to April 1st. So in that case, only the wages from March 13th to March 31st would qualify. This is why I'm saying work papers by person are required.
Right. Another one is, you mentioned unproductive, right? What does that mean exactly? Furloughed and still paid, or not able to do their job 100%? Can you take a percentage of their salary?
The answer to that is yes, 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 yes. So, but within bounds. So of course, what they want is for you to say, hey, I'm a school and I have a bunch of bus drivers. My teachers are working, but my bus drivers are sitting at home because I got no kids to drive. That's the ideal situation. You've paid your bus drivers, or maybe you've even just only paid their health insurance and they're doing not a lick of work. That's simple. In other cases, like we have gyms, where all the trainers are gone, the gym is shut down, but they kept paying all the managers. The managers had no one to manage, but they checked their email every day. In that case, you need to document probably a % of their exempt time. It gets a little tricky. It's easier with hourly people. And you have to document what they say is not nominal subset of people. And of course, this is only applicable if you have more than 100 or more than 500 people. And you have to document individual productivity. But that's where the HR task comes in.
All right, and then the last question is, and we do have case studies after this, guys, so this is not our last slide. Last question is, are eligible wages for the ERC both W-2 payments and profit sharing, Schedule K to 1? Is it specifically for a single owner, S Corp, where the owner receives both W-2 income and the Schedule K income?
Okay, no. The ERC is a credit against your 941. So it's a credit against your taxes, your employer portion of Social Security, and above that you get it back. You cannot use it for K-1s. It has to be W-2s, first of all, and it excludes owners and owners' families. I maybe would think about including an owner family member if they were truly contributing to the business and were not also a majority owner, but otherwise excluded, okay? These case studies will also be in our deck. Lou, do we need to quit, or do you want to go through the case studies?
No, I think we have a little bit of time for a couple case studies. And I encourage, if there's other questions, continue to put them in the section, and we'll try to get to, as many as we can. We'll probably cut this off in 10 minutes.
Okay.
Let's just kind of keep going.
No problem. I have extra time. So just to give you a little bit of bang for your buck here, I wanted you to know that the numbers. So on the left is a cosmetic company that was a retailer. And because they have less than 100 staff, all the wages were eligible during the shutdown period. So after that shutdown period, they were able to go back to the office and or not. They were really telecommuting and they were productive. But just during the shutdown period where there was government orders, before they got their PPP too, they got that this year. We were able to get them, I think it ended up being $185,000 in the end. The middle is a nonprofit. They had less than 20 staff. We verified they were non-essential, of course. That makes it pretty easy. What was tricky was they got some revenue from the state and Fed sources, and so we had to pull that out. But because they had less than 100 people, they got a $75,000 credit, and they only had 20 staff. For this little nonprofit, it was a super meaningful amount of money and a very rewarding project for us. Then this gym on the right, we have several franchises that are big fitness franchises, tons of staff, but clearly not essential. I'm sure you all have had bummers where your gyms were shut down. So we have shutdown periods, then they get open again, then they get shut down. So what we do is we go and we get the government orders, we carefully document the period of the shutdown, and we also document that they were down in receipts. And we document, this is the question you asked, how much were people working? Most of these gyms, the people who are left are sort of working. They're doing what they can. And so we document it very carefully. So for 800 staff, we ended up with a $750,000 credit. It was really huge, okay? Now here's where we get to some biggies. That left one is an essential business. This is interesting. So you would think they don't qualify. They are a food manufacturer. However, the shutdown orders affected certain parts of their workers in certain locations in certain states. What was interesting was they were shut down in the Midwest in a few cities totally and not deemed essential by the locals to a certain degree. And so we were able to get the credit for them using very specific orders and identifying the non-essential. I mean, they're non-essential if they're sent home, and they were still paying them. Let's see. We had multiple entities. This middle one, they were a manufacturer, and they had a big group, 3 different companies, and we did 3 different credits for the 3 companies that they owned. What they had were FFCRA wages, meaning they paid a lot of people on COVID leave. We had to back those out, but we still ended up with $280,000. And then the one on the right was the absolute trickiest. Thousands of staff, a giant telecom business, clearly essential. But they had workers who had to work in laboratories who couldn't do their job in the lab. And then there were other people who were exempt. They were on salary. And so it was complicated. We had to determine a percent of time that they were utterly useless and a percent of time that they were working. The way that we did it is we used job descriptions, postings. They had a posting section for the HR department where they would post for these positions that were affected, and they would say what this job entailed. And we could say, look, there it says you have to go to the lab. They couldn't go to the lab, therefore they were paid for this period of time they couldn't do their job. That one was well over $500,000, even though I think there was only 30 to 50 people who were affected who could not actually do their job on site. Everybody else successfully transitioned to working from home. So as you can see, these amounts are really big. We have one that we did that was a $1.1 million credit, I think. So it's significant money. You just have to do a lot of work to document your eligibility. All right. This is a flow chart that I want to put in the leave behind for everybody in case you're a more visual person, because the other slides were words. And I've got a flow chart for 2020. And on the right, I want to have your eyes go over to those forms, 7241. If it's, you can file this year, you can file a 7200 and get the credit advanced to you. If you're going back to 2020 to get the credit, you file a quarterly payroll return 941X. And you amend it, which is only slightly painful depending on who your payroll technology provider is. And I think with that, Sarah, do you have any other weird questions?
We have one question that came in. Sorry for the echo. Does ERC applicable to a single owner employee?
No, it's not. The ERC does not apply to owners at all. They're the only ones that you got to take out. Actually, also clergy, because they don't pay Social Security. We'd have to take out clergy, okay? But nonprofits are eligible. If you need anything, you guys, again, this is in your slide deck. You can call us, you can write us. If you need help, go with PPP or ERC. The experts at Armanino LLP email gets routed to those of us who can answer your questions. And the COVID Resource Center has so much content. We really have done our best to pour out content that is applicable to businesses who are a little bit distressed right now, people trying to figure out whether they can go back to the office. We've got HR stuff, payroll stuff, credits, and some really cool technology when you go there. Our tech teams have created really cool COVID trackers, and a lot of people go to our website to check out vaccinations, where they're rolling out, where hospitalizations are heaviest. It's really a nice place to go and check things out.
Awesome. Well, hey, thanks, Jen and Sarah. I really appreciate you guys jumping on here and pulling all this together. I think you just did a marvelous job of summarizing and kind of hitting some very key highlights of two somewhat complex and rapidly changing items here with ERC and PPP 2.0. So really appreciate that. I think, you know, as a former CFO, and I think for some of the people that are on this webinar today, hopefully it kind of jogged some things that said, hey, I think I should look at that, or I probably need to explore this a little bit more, or at least I ought to ask some questions and just see if there's money out there for the businesses that we work with and consult with. So I think that's been great. Just a quick reminder, I think each of you that registered, you will get within 24 to 48 hours a recording that will include all the slides and I think the link to the FAQs that they have. And so if for some reason you don't, please reach out to the contact information either you have there, or you please just send me an email at lou@lewslist.com, and I'll make sure that you get it. So thanks again for attending, and have a great rest of your evening. Thank you.
Thanks, everybody.